Hey, this is Greg Wilcox with DaVita Home Finance, your local mortgage expert. Hey, I was just talking with a client earlier this week about credit scores. And this particular client was just a little bit concerned that the credit score that we obtained when we checked her credit was so different than what her credit score was when she checked her credit. And that really led to a very interesting conversation. And it's something that I think a lot of consumers should understand and often deal with in all sorts of credit transactions, whether it's trying to get pre-approved for buying a home, or you're looking to buy a car, or you're wanting to open up a new credit card account. Understanding how those scores are calculated is crucial. And then also understanding why there's a difference between these scores is also important. And so in my conversation with my client, we really talked about, why is it that when she goes and gets her score from, in this case, Credit Karma, it's so much higher than the score that we got when we checked her credit. And so that comes down to understanding a little bit about how credit bureaus actually create those scores. There are actually dozens and dozens of different mathematical models that are used to create that little three-digit code that you get, or three-digit number, that you get. And really, which one of those models gets used to do the calculating depends on a couple of things. It depends on the type of creditor that's checking your credit. It also depends on your behaviors. So how you use your credit will also influence which of the models gets used. So as an example, if you check your own credit using Credit Karma or any of the credit.com companies out there, or your free stuff with your credit cards that gives you the little score there sometimes, just keep in mind that what's going on there is you're accessing a model through the credit bureaus in which there is no risk of you opening a new account. Okay? So when I or any mortgage creditor or any car loan or credit card company checks your credit, what's happening is the model that gets chosen to score you is taking into consideration the fact that there is potentially a new account that's going to be opened. And so it's using a different model to score that. When you check your own credit, there's no risk of you opening a new account during that credit check. And so the consumer credit check is one where you see on those sites, it's usually a lot higher than if it's got the same information as is available in other credit checks. It's usually going to be higher because there's no risk of a new account being opened. And so now you'll also notice there's a difference when a mortgage creditor, a mortgage company checks your credit. The scores will be different than if a car company checks your credit or a credit card company checks your credit, because each different type or category of creditor will trigger a different scoring model to be used. And so what I ended up just leaving my client with was, for purposes of the mortgage transaction, we've got to work with what came through on the mortgage credit check. And by the way, mortgage banks have every incentive to want to finance somebody into a new home. So there's no shady stuff going on there. That's how they make their money. But that is the credit score that we've got to go with. And I told her, use your Credit Karma scoring as more of a barometer of what's generally happening in your credit. If the score is going up, that's a positive sign. If the score is going down, you really want to take a look at what's going on to cause that. But don't focus on the actual score number, because it's going to be different no matter what you do. If you've got any questions about this message, please message me below or shoot me a call or a text, and I'll be happy to help you.